Good afternoon and welcome to BizTech's ASEAN Midday Market Watch. Our guest today is Vishnu Varathan. He's the head of economics and strategy at Mizuho Bank out of Singapore. Vishnu, great to have you back on the show.
Thank you, Brian. Thanks for having me. Always good to be here.
Now, Vishnu, the House just passed the bill for the $2,000 stimulus checks. What's the market expectation on the Senate then passing this bill?
I think the fact here is they are treating this as the bonus that might come along. They're not holding their breath for it. The biggest relief that we saw was the fact that Donald Trump signed off on the bill already agreed upon, whereas I think there is enough cognizance around that there is going to be quite a bit of Republican resistance to raising it to $2,000.
And the thing is also, I think one of the key challenges then moving forward is the fact that the markets are concerned that perhaps a Biden administration may not be the most favorable to markets. Is that a view that you hold to be true?
I mean, typically and traditionally, we've always looked at Democrats as being rather unfriendly for markets, as well as global trade back in the day, because Republicans were supposed to be the business-friendly ones. Whereas now, I think the first thing is we need to contrast a Biden presidency against not a Republican presidency, but a Trumpist presidency. And the other one is, I think Biden's a lot more nuanced than that, as have been many of the Democrats. So it's not going to be outright unfriendly for markets. I think there are going to be aspects of it which can be very, very stimulative. Example, the infrastructure spending plans that he had, the $2 trillion, including for the tech sector. So this would have been a huge boost, whereas markets typically do not like any hikes in tax or tighter regulations, which he also had on his book. So now really it depends on the speed and the form of in which these are passed, if they are able to pass through what might be a split Congress contingent on the Georgia runoff.
Now, let's move on to China a little bit. And roughly 2/3 of executives surveyed in the China Beige Book said that they don't expect their company's sales, profitability, or hiring to return to 2019 levels at least until 3 months from now. Now, this seems like a sharp contrast to the official statistics, which show sharp increases in numbers to pre-pandemic levels. So what should investors read into this survey?
I think as sharp a contrast it might be, it's not incongruent either, insofar that I think businesses are going to be pretty circumspect, and justifiably so, because a return back to pre-COVID norms, so to speak, if you can even use that word norm, would be considering whether that vaccine rollout yields a certain level of global resumption of activity. This needs to be on a global basis, not just within China. So I think they are very cognizant of that. And I think there's also a sense when you're on the when you're on the ground in a business, you're also very cognizant of things like how the cost push factors. I apologize for the economist wank term, but what we really mean is that things like costs, freight costs, commodity costs, all running ahead of the recovery means that margins get squeezed as well. So yes, businesses are just being, I think, very cautious here, and rightfully conservative about when they can restore and durably restore profits. And so they're not looking at a sudden windfall or things like that, but rather a sustained pre-COVID activity demand levels, which rightfully we think will only come through second half of 2021, if that.
If that, okay. And what would be a worst case scenario then in terms of the recovery? Because the consensus among analysts seems to be second half recovery. But what are the spanners in the works that will potentially then delay this recovery?
So you're really putting me in my element and asking me to be a pessimist, which I'm very happy to be. And so here's the thing. I mean, in terms of what the spanners in the work might be, this could include things like, the growing tensions between US, China, even as the Trump administration is exiting. You've already got the OFAC list. You've got a lot of strains, whether it be via the financial channels or, via trade channels. we also look at China itself as a risk, stumbling and tripping over its own feet. And one of that is the, related to the Alibaba situation, but a broader theme, which is regulatory missteps or policy missteps where policies seem to be tightening too fast, too soon. And one of the biggest, for us, the biggest risks out there is, fears that there could, that credit rollover could become tough, and that could spark a contagion. So all these things are actually air pockets out there in 2021 where growth can fumble. And it may not be a permanent setback, but these are things that can retard and perhaps dampen a fuller recovery.
Now, Vishnu, moving on to something that's flavor of the month right now, which is Bitcoin. Now, Bitcoin hit its record highs this week of 27,000. Last week, I think it was earlier, I think it was it went down to 18,000. Now, so over a year, it's moved from, bringing the periphery into mainstream investors with institutional investors piling into investing in Bitcoin. You even have the lights of a DBS bank in Singapore setting up an exchange. So what's your view on Bitcoin, and what are you advising your clients to do on 2021?
Thankfully for me, I'm not obligated to advise clients on Bitcoins, and I continue to not to do that. But we do need to share some thoughts on it, and here's a starting thought. I think the element of the FOMO dimension to this, the fear of missing out on a startling rally of these sorts, certainly must be one to consider. So no one can measure this, but we need to get a sense of how much of that is driving the market. And the other point is, we have got no, we were not dead against Bitcoin as an alternative asset class, as it's clearly turned out to be. But to fully bank on it as the future of money may be a bit premature and even misguided insofar that, the cost of the coin is huge. The volatility is excessive. And at the end of the day, the irony is that it performs best not for the reasons it was put out there. The reason it's being put out there was as the currency of the future, which is not. It's a store of value if you can stomach volatility. So it is a very risky store of value, and it is a viable alternative asset class which has risen in prominence, in particular because this time around, unlike the GFC, we have had all central banks going into some kind of a balance sheet expansion, QE type, which then brings into question the value of fiat currencies, which is why earlier gold also outperformed phenomenally. But Bitcoin probably has got the, the advantage of not being as spooked by slight rising in the slight rise that we've seen in USD yields. Typically, gold doesn't do very well when USD yields rise, being a zero yielding asset. But as an alternative asset class, I guess Bitcoin has got some allure. Our only reservation about this is that it's oversold on too many dimensions.
Okay, Vishnu, thank you very much for your insights. Now, we've been speaking to Vishnu Varathan, the Head of Economics and Strategy at Mizuho Bank, on BizTech's ASEAN Midday Market Watch. I'm Brian Fernandez. Check out www.biztech.asia for business and technology conversations.